Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The rise of the market back in late April, up through all the moving averages as well as up through some considerable congestion between September to November last year and again in mid-January to mid-February this year. This was the final creation of the early February to late April reverse head and shoulders bottom that gave us the move higher in the first place. If you wanted to pick a date, then the 23rd of April for clear close over the neckline of this reverse head and shoulders bottom, dark blue neckline currently at 580. That was the day. By the way, please remember that neckline. Please remember it, as it will feature again in more recent action. Okay, so the rise moved up swiftly and achieved its primary target at 635 and its harder to reach secondary target at 655, which was above both the small October to November 2020 head and shoulders top neckline extension, currently at 667, and the earlier December 2023 base double stroke triple top pattern. In reality, the market blew through these resistances pretty easily and went on to easily push up through the 50% Fibonacci line of the July 2023 to March 2024 move at 660, which was a little bit surprising as I thought we might see some resistance there, as well as clearing the 50% absolute Fibonacci line at 682, which was even more surprising, though prices did choose to take a rest after pushing through and utilize the 50% absolute Fibonacci line as a support before the attempt higher. It was only at the March 2014 high at 725 where we started to see the tempering of the aggressive move higher, peaking at the January 2022 low at 739 3 weeks ago. In the process of moving higher, the market created a late April into May very steep and very acute purple highlighted bull channel. It has become somewhat of a bullish expanding wedge pattern. I said about this pattern 3 weeks ago, and I quote, "This bullish pattern will run this market until something comes along, something suitable to challenge it." And I think I might have spotted something that may do that. I had to go back to my longer term charts to find it, but just up ahead is the neckline extension to the big, yet very thin head and shoulders top from the big moves of 2021 to 2023, and that's currently at 756. I suspect as we approach this neckline, we may see some trepidation and possible anxious and apprehensive behavior. I know I would be if I was approaching it. End of quote. The market's approach during mid-May to this neckline caused enough of a situation to occur that prices exited by effectively just going sideways, out of the purple highlighted expanding wedge pattern and down through the very steep uptrend. 2 weeks ago, and to a lesser extent last week, prices plunged lower, down through both of the previously highlighted 50% Fibonacci lines and down last week to the green highlighted short medium moving average, currently at 635, finishing last week below it for the first time since mid-April. On this matter of last week's actions, I said the following on my last commentary, and I quote, "Now, I will draw your attention to one small pattern formed from Friday last week to date." So that is actually Friday, 2 Fridays ago through to last Friday. From last Friday until last week until date, a small descending triangle highlighted but very lightly in pink on my daily chart, as if I made it any stronger it would obliterate the pattern. We are on the edge of breaking lower from this pattern, which would give such a pattern a primary target X in the 613 zone, and a harder to reach target, secondary target X1 in the 597 zone. I realize I'm giving these targets without any confirmed break lower, purely because it is a small pattern and the targets may be easily reached during next week, so that's this week. However, I'm mindful this might be a false break lower as well, in which case I'll deal with any breaks higher next week. So that's this week again as well. End of quote. Well, this week saw no false break lower, but the move being a true break, and both the primary and secondary targets have been reached this week. In the process, prices have punched down and closed below the July 2021 low at 609 and the March 2021 low at 592, plus the combination of the mauve highlighted medium moving average and the gold highlighted long moving average. That's currently 606 for both of them. By the way, these two moving averages do not appear to be making a golden cross. The drop has been as far as that same old dark blue reverse head and shoulders bottom neckline, currently at 580. This is what we are testing right now. Should this give way, then the next support is the December 2020 low at 566, and I suspect that we might see a slowing down towards there as the congestion throughout February, late April, mid-February to late April starts kicking in under 588 and goes all the way down to at least 545. So watch out for potentially some slowing from now onwards. This would also tie in, doesn't stop, just slowing. This would also tie in with the idea of us looking at the small pink descending triangle as a possible halfway hesitation on the way down. Chicago corn. The medium moving average, currently at 449, had been an effective cap on this market throughout 2023 and once again capping rises in late March and April. But in early May it was breached and effectively turned into support. Prices went on higher through May to tackle the bright red highlighted extension to the lower trend line, currently at 467 of the July 2023 to January 2024 descending triangle, as well as the long moving average, currently at 467. And tackled those two for most of May. In the overall course of the move high, it allowed me the opportunity to eventually draw a late February to mid-April bullish shift pitch, which you can see is highlighted in dark blue on my daily chart. Even as I was composing my words for this pattern 3 weeks ago, the lower time, currently 468, was under bearish pressure, closing not only below the lower time but also below the green highlighted short medium moving average, currently at 456. 2 weeks ago, prices had pushed down below the next significant support, the mauve highlighted medium moving average, currently at 449. The reason for this move lower was what had formed throughout May, a small double top. In reaching down to the medium moving average, the market had also reached its primary and harder to reach secondary targets, as well as making a weekly key reversal down 3 weeks ago. Now, 3 weeks ago, I said about the move below the medium moving average that it was, and I quote, a significant level as it is the doorway to the main congestion between 440 to 450 that is the essence of the big February to date halfway hesitation in the first place. So you can see there's a lot below the lower tie, and I'm not sure the market can take it on as yet. End of quote. I added 2 weeks ago, and I quote, that is why we have seen a reversal back up yesterday. That is Thursday, two weeks ago. That's why I've seen a reversal back up yesterday with an immediate countering bullish engulfing pattern and key reversal up, if only just on the latter. So what now? Well, there is the possibility that the market may now use the dark blue lower tie as a rolling cap on the market and run along the underside of this. I'm not sure it has the strength as yet to push higher over the bright red neckline or the long moving average overhead, nor as yet the strength to take on the previously mentioned 440 to 450 congestion below. So we might well be looking at a wide 440 to 450 on the bottom, up to 465, 470 range on top, with possibly a market moving along the dark blue broken lower tie. End of quote. And that is what exactly happened last week. The dark blue lower tie is the overhead resistance, whilst below we have a new, very short pink highlighted uptrend, just over 2 weeks old, and it's currently at 455, that became the immediate support. What is more, these two trend lines combined made a small ascending wedge pattern, say currently 460 to 468. I said last week, and I quote, I can't give an idea of the direction yet, but that the market will break, nor a proper size of the move. I suspect the move right now may be lower, and I can, if prices broke through today, I can give an idea of the size of the move. Thus, for a confirmed break lower, we would have a primary move of 6.5 cents with a secondary move of 20 cents. I hope to give fuller details possibly next week. End of quote. Well, by Tuesday this week, we had that confirmation, and what is more, both the primary and secondary targets with this small ascending wedge pattern have already been achieved. And we have seen an extension lower down to approach the November 2020 high, and a significant low throughout late March and April at the 439 level. So what happens now? Well, I'm not sure, but it would not surprise me to see prices now start to slow around the 439 level. But all this action does prompt a question, a significant question. Is the action since late May a possible bear flag with potential down to approximately the 433 level? Or is it part of a larger whole of 2024 double bottom pattern with potential down to the February this year and the December 2020 lows at 414? These are my immediate questions and thoughts about what may be happening. Kansas City week. My apologies for some of the labels being highlighted in bright red. Sometimes my charting system throws a wobbler and does this sort of thing unintentionally. So please note there is no special meaning to any of the labels being highlighted in bright red. Okay, so late last year we saw the development of a descending triangle from late November 2023 to mid-February 2024, highlighted in purple on my daily chart. 14 weeks ago we had an attempted breakout below, but prices hesitated. Then continued to hesitate such that what I initially thought might be a triple or quad bottom eventually became a quintuple bottom, and also a rectangle pattern. On the 22nd of April, yes, I can narrow it down to a single day. On the 22nd of April, we saw the first significant breakout of this rectangle pattern on the upside, piercing, and then the next day closing over the mauve highlighted medium moving average, currently at 620, which had run in parallel and just above the purple highlighted upper trend line, and then later the lower trend line of the descending triangle. The move higher accelerated through some significant resistances between 691 to 707, and I said as much 7 weeks ago, and I quote, "Do I think prices can make it this high soon? It is a reasonable point of view, especially if you look at the last few weeks' actions of potential bullish halfway hesitation, as it will lead prices right there as a target area, and the long moving average on its own would not necessarily be enough to hold down prices on its own, especially with the ammunition gathered in the rectangle below and earlier this year." End of quote. However, the market did not form a bullish halfway hesitation. Instead, it opted for a bull channel. All this is well and good, but what lay ahead for the market? Well, I said 3 weeks ago, and I quote, "We have congestion at 763 to 764, 787 to 791, and 808, but the first obstacle, and arguably the most significant of these, is the combined June 2014 high and 2022 low at 748. However, at the moment, I do not feel that this would be that much of an obstacle in any rise, given the amount of ammunition the market has accumulated since September last year. However, not far beyond that, and we do have some serious overhead resistances. This is not obvious on my daily chart, but back between January to August 2023, the market formed a huge inverted roof pattern that played out nicely thereafter. We start entering the apex of the inverted roof pattern from about 740, but it will take a little while to truly venture into it, so caution." End of quote. Well, that caution proved to be valid, as the overhang from the inverted roof pattern from the big pattern last year really pressured this market back down, such that 2 weeks ago prices broke down through the big 50% Fibonacci line of the 2011 to 2019 move at 691, and last week punched down through and closed below the combination of the January 2015 high at 646, the long moving average currently at 639, and the green short medium moving average currently 651. As I said last week, and I quote, "Today's significant close below all of these now sets into the frame the combination below the flatlining mauve highlighted medium moving average currently 621, the interesting 38.2% Fibonacci line of the big old 2011-2019 move at 618, and a new unhighlighted April to date uptrend currently at 625. This is the next zone to watch below. And if that goes well, we may well start a move down to the declining purple lower trend line, currently at 584, of the old descending triangle." End of quote. Well, this week, prices have dropped and closed below all of these, and we are now approaching the declining purple lower trend line. The question for next week is whether this will hold or not. Right now, I personally think this purple trend line is not a line in the sand, but rather the start of layered support, stretching from about 590 down to somewhere between the March 2021 low at 559 and the March this year low at 551. So I would watch out for a possible slowing and even a halt under the purple trend line. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.